Okay, in this tutorial, I'll be going through with you the stock CCNI, and I'll just copy that, I'll paste that and click stock, and you can see the name of the stock, and I'll just write one more thing, technology besides it, just, no, that's fine. Okay, so let's go. So if I want to buy the stock right now, what price I have to pay? I have to pay 5.71 US dollars, okay? If I want to know when was the firm founded, it's written founded 2002, so it's a recent firm. I'll explain you the sector later in the video. Uh, let's see at the four ratios that I'm very interested in that will give you a snapshot that how the firm is doing. I have pasted the link in my description. You can just click there. You go to macro trend and go to price ratio, then price book ratio, and you just type in the symbol of the stock and make sure that the symbol matches with the exact name of the firm, because sometimes a lot of firms have the same symbol, so that's why price book ratio. Now I'll explain you briefly for those of you who don't know what that is. So book value is the real price of the stock, real worth of the stock, and the stock price is what you can buy that from the market. For example, if the real value of the stock is $1 and the stock price is $2, it means that you're paying $2 to buy something that is of worth of $1. So you're buying it expensive because the worth is $1, but you are paying it um, $2 for that price. So you're buying it expensive. Now the ratio of price book ratio should be uh, at least one, okay, or less than one, which will give you bargain. So you are buying, if it's less than one, then that's a discount. If it's more than one, that's expensive. So let's see, it's 1.44 right now, which means it's like a little bit more expensive than, it's like 1.44 times more expensive right now. It was 1.01, so a little bit expensive, like few cents more in 2019 March. So you can see just vertically up that the real worth was 3.89, but you could buy that 3.89 by paying 3.93, so a few cents more, 1.01. But in December 2018, it was 0.99, which means that you could get it in at a discount. So it was 4.04 worth, but you could buy it for $4. So it was cheaper to buy that time. So right now it's 1.44, a little bit like it's getting higher. Okay, and let's look at other ratios. Uh, Current ratio means that if it's above 1, that means assets are more than liabilities. If it's below 1, then liabilities are more than assets. Ideally, we are looking for a stock to invest in a stock that is less risky. It's not risky. So the current ratio should be 1.5 or more than that for it to be less risky. The current ratio is 3.32, which is brilliant. It's a lot more than 1.5. Okay. Then if I just go back, it's 4.82, which is brilliant. And I just go back, and if I see from 2014 March, it has been above 1.5 consistently. But before that, it was 1.45. Still, the liabilities are less than assets, but I'm looking for 1.5 for it to be very safe. 1.22, which is good. You know, but if you look in 2010 March, it's 0.56, which means the liabilities are a lot more than the assets. If you just look vertically up, the liabilities are zero point zero 0.01 and asset is 0, so it means the liabilities is quite a lot more. So this means the stock was risky that time because liabilities were more than the assets. If I go back, it's still the liabilities are more than the assets continuously, and then it's fluctuation, it's up and down. But from 2014, the situation has improved and it's above 1.5. So it has, in 2014, it has become a safe stock, right? It's not risky because it's above 1.5 and it has been consistently above 1.5 for like now 5 years, so which is a good thing. So let's see that equity ratio. This ratio tells us if the stock is operating mainly on debt or on equity. If it's operating mainly on debt, then it's not it's a very risky stock. If it's operating mainly on equity, then it's safe stock. The ratio we're looking at is zero point 0.5 or less than that for it to be in a very safe zone. But I guess we don't have any information regarding this on this website, so I can't judge if it's what's the situation. But it gives me a slight information that in on 31st March 2019, actually it does give me information right now. Sorry, it was just loading. So it's 0.05, which is brilliant because it's less than 0.5. Let's go back. It's 0.0000000, and then minus 0.21, 0.67, so which is more than zero point 0.5 in 2019 September. Then that's 0.59, 0.35 less than that. Okay, so it has been consistently just twice in the past. I would say 3 months. It has been above zero point 0.5, but the rest, the history and the present is very brilliant, less than zero point 0.5. So maybe 2 times I will just ignore it because that's not a big thing. I'll go to return on equity. This will be, if it's 8% or more than that, then it's in a very safe zone. Even if it's 1% return on equity, which is good because it's return, we're getting a return, but the return is very small. I'm looking for ideally 8% or more than that. But I guess I don't have information for this one. But it says that on 31st March 2019, it's 7.93%, which is nearly 8%. But I don't have previous information, so I don't know about the previous one. I can't judge that. Maybe some other website have it, so you need to look at that as well. So it should be 8% or above that for it to be like, really good, safe. Now let's search it in Google, and I'll just copy that and I will just search the reviews in Indeed and to see what the employees have to say about it. And you can see 9 reviews, okay, which is not a lot to judge a company, but still it has 3.4 reviews, which is brilliant, which is average reviews, but 9 reviews is not quite less. So I'm not sure if I can, decide something on it or not. And then you just go to Glassdoor reviews, and let's see, Glassdoor reviews have 76 reviews, which is you know these are like okay enough reviews. 76 reviews is more than Indeed, and gives me 2.6 star. So you can just read through it and you can see what employees have to say about it and stuff like that. It just gives you better information. Let me go to Yahoo Finance and I will show you some things. If I just type the stock symbol here or whatever, and the symbol and the name, you can type in the name or the symbol. I go to profile and it just tells me from here the sector. It's industrials, industry, staffing and outsourcing services, and full-time employees is 210. If you look, the key executives are very important of the firm. If you look, there are 4 key executives shown, and only 3 of them have shown their salaries. One of them has not. There's no salary shown. So you can investigate why it's not shown. Maybe this Yahoo Finance doesn't cover it. Some other website has shown it, so because the more transparency, the better. So you need to look into it. And last but not the least, we'll go to Justia Patents to see if this firm has any patents, because patents give you competitive edge. It acts as a moat, and it's very important if some firm has patent. And I can't see any patent as such. No, not for this firm. I'll just type again. Let's type again. No, it doesn't have any patent. I can't see any. So just one sec. Command Center Inc. Seating Inc. Is that the one? No, it doesn't. No, it doesn't have any patent. Maybe so. Okay, that's fine. It's good to know if some firm has a patent or not. It's a competitive edge. And what else I need to show you? Just that, yeah.